We often think of the U.S. stock market as, its own thing, reacting mostly to what happens here at home.
Yeah,
But the truth is, these global financial markets, they're incredibly tangled together. Something happening way over there can absolutely cause ripples, sometimes big ones, right here.
absolutely. And I think for investors, the perennial question really is how do you even begin to sort through all that foreign information, that noise, to find the bits that actually matter for U.S. stocks?
Right, the signals and the noise. Well, today we're doing a deep dive into a really interesting, fairly new way of thinking about this. It's called foreign signal radar. And the idea is basically using machine learning, AI, to slice through all that global data and spot useful info from overseas. Info that might predict how U.S. companies are going to perform, and not just the huge multinationals, but domestic companies too.
That's the intriguing part, extending it beyond the usual suspects.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So our source today is a research paper looking into exactly this.
Exactly. A paper that really gets into the weeds of this strategy. They analyzed just a staggering amount of data. We're talking lagged returns, so past performance, of whole stock markets and even individual stocks across, I think, 47 foreign markets.
47, yeah. And the scale of the computation is pretty wild, too. They trained over 100,000 different machine learning models trying to uncover these links.
Wow, over 100,000 models. Okay, so our mission for this deep dive then is pretty clear. Figure out how this machine learning approach actually works, how it identifies these foreign signals.
Right, the how.
Then explore why these signals might even be predictive, what's the theory, and crucially, what are the potential downsides? Is it actually practical?
Exactly. Let's start with the strategy itself. The core, as you said, is using these machine learning algorithms to find patterns. They essentially fed them historical data specifically, lagged weekly returns from those 47 non-U.S. markets, both market level and stock level, to see if that past foreign performance could predict future daily returns for stocks in the S&P 500.
Got it. So looking for those early warnings maybe from overseas markets about what might happen here tomorrow or the next day. What kind of ML tools did they bring to bear on this?
They used a pretty diverse toolkit, actually. There was Lasso, which is really good for variable selection, sort of zeroing in on the important stuff and ignoring the rest, keeping things simpler.
Right, cuts through the noise.
Then they had tree-based methods like random forest and gradient-boosted trees. These are generally quite powerful, good at finding complex patterns, and usually pretty robust against overfitting, which is always a risk.
Okay.
And they also threw in neural networks, to see if there were maybe even more complex nonlinear relationships hidden in there that the other models might miss.
So a real battery of tests, trying different angles. How did they make sure these models weren't just, really good at explaining what already happened, but could actually predict the future?
Ah, yes, the classic overfitting problem. They relied heavily on out-of-sample testing,
Right.
which basically means they trained the models on a chunk of historical data, say up to a certain year,
Okay.
and then tested how well those trained models predicted returns in a later period, data the model had never seen during training. That's the real test of predictive power.
Like building a weather model on past weather and then seeing if it correctly predicts tomorrow's rain. Makes sense. Now, you mentioned the data started with market returns, but then expanded.
Yeah, initially they focused on 188 foreign market return signals. That was using weekly returns lagged 1 to 4 weeks from those 47 markets.
Okay, manageable.
Relatively. But then they really broadened the scope. They added in lagged weekly returns for individual foreign stocks as well. And that just exploded the number of potential predictive variables to around 13,000.
Whoa, okay, 13,000 potential signals. That's a lot to sift through, finding the needle in the haystack, right?
Pretty much. A huge dimensionality problem, as they call it.
So after all that model training, all that out-of-sample testing, Did they actually find foreign signals that had genuine predictive power for U.S. stocks?
They did, yeah. The results were quite interesting. They constructed these long-short portfolios based on the predictions.
Explain that a bit. Long, short.
Sure. So based on the model's daily forecasts, they'd notionally buy the U.S. stocks predicted to perform best. The top 5% say that's the long part. And simultaneously, they'd short sell the stocks predicted to perform worst, the bottom 5%. That's the short part.
Okay, betting on both ends.
Exactly. And the idea is to profit from the difference in performance between the winners and the losers. And some of these strategies, particularly the one using Lasso, generated pretty substantial abnormal returns around 14.2% annualized before costs.
14.2%. That's definitely enough to make you take notice. Now, here's something I found fascinating in the paper. The most useful signals didn't always come from where you'd expect.
Right. That was one of the standout findings. You might think, okay, signals from Germany or the UK, or maybe from foreign competitors in the same industry, those would be the most potent.
Yeah, that's the intuitive guess.
But the analysis often highlighted signals from less obvious places. Qatar, for instance, kept popping up as important across different models.
Qatar. Why Qatar?
Well, the paper speculates it could be due to its significant role in the global energy market, LNG especially, and maybe its geopolitical position. Factors like that can have broad, sometimes subtle ripple effects globally that maybe aren't immediately obvious but show up in market data first.
Huh. So it challenges that simple intuition. What's the underlying theory then? Why should, say, Qatar's stock market last week tell us anything about a U.S. tech company today?
It boils down to that global interconnectedness we started with. Think about global competition, intricate cross-border supply chains, and how global events, conflicts, pandemics, trade disputes affect companies everywhere, directly or indirectly. So stress or opportunity occurring in one part of the system might foreshadow effects elsewhere.
Okay.
What was particularly novel here, as you mentioned earlier, was finding these links not just for the big multinational firms, which previous studies often focused on, but also for U.S. companies that are primarily domestic. That suggests the connections are deeper and more complex than maybe we assumed.
Like maybe a disruption in a small foreign supplier eventually impacts the costs for a purely U.S.-focused retailer.
Exactly. Those kinds of indirect links. You also asked about standardization earlier. They did standardize the foreign signals.
Why was that important?
Because stock market returns naturally have different scales, different levels of volatility across countries. An emerging market might have much wilder swings than a mature one. Standardization basically adjusts for that, puts all the signals onto a comparable scale. It stops the models from just latching onto signals from high volatility markets simply because they move more, rather than because they contain genuinely useful predictive information.
Got it. Levels the playing field for the data itself. Okay, so we have the strategy, the theory. Let's dig into the results more. How strong was this predictive power they found?
They measured it using something called the out-of-sample R-squared, or RU. It basically tells you what percentage of the future variation in U.S. stock returns could be explained by their model using these foreign signals. And they found statistically significant predictability for a decent chunk of the S&P 500. Using the Lasso model, for example, they got a positive RU for about 24% of the stocks.
24%. So not for every stock, but a meaningful portion.
Exactly. It suggests foreign signals matter, but perhaps selectively, or maybe the signals are just easier to detect for some firms than others.
And did this predictability differ much between, say, big global companies and the more domestic ones?
Surprisingly, no. The paper reports that the predictability was actually quite similar across multinationals and domestic firms, and also spread across various industries.
That reinforces the idea of those complex indirect links again, doesn't it?
It really does. Another fascinating result was the connection to media coverage.
Ah, yes, you mentioned that. What was the link?
They found the strategy worked better. The foreign signals had more predictive power during times when those specific foreign markets were receiving less attention in the U.S. financial media.
Less attention means more predictive power. That seems backward.
Well, thinking is this. When a foreign event or market trend gets a lot of press coverage, everyone sees it. Information gets disseminated quickly, investors react, and it gets priced into U.S. stocks faster.
Okay.
But when things are happening more under the radar, without big headlines, the information might seep into the market more slowly, perhaps carried first by these lagged return signals. That creates a bigger window for a strategy like this to potentially capture that delayed reaction.
So the value is in finding signals before they hit the mainstream news cycle and get priced in by everyone else.
Precisely. It suggests information inefficiency, basically. They also use techniques like SHAP values to try and understand which specific signals were most important.
Right. Trying to peek inside the black box bit. What did that show? Which signals mattered most?
It confirmed that importance wasn't just concentrated in, say, the immediately preceding week. Signals from 2, 3, even 4 weeks prior still held some sway, although generally the importance did decay over time.
So the information takes time to filter through. How long did they estimate this process takes?
Their analysis suggested it's actually a relatively slow diffusion. Based on how the signal importance faded over the lagged weeks, they estimated time windows for the information to be fully absorbed.
And what were those windows?
Depending on the algorithm, they estimated something like 5 weeks for random forest, maybe 6 weeks for lasso and gradient boosting, and potentially up to 8 weeks for the neural network model, though that was based on some modeling assumptions about acceleration.
5 to 8 weeks. That feels surprisingly long in today's fast-paced
It
markets.
does, doesn't it? It suggests there are perhaps more frictions or delays in how global information propagates into U.S. prices than we might think.
Did they identify factors that influence that speed? What makes information travel faster or slower?
Yes, several things seem to matter. Information from emerging markets tended to be absorbed more slowly. Same for markets with lower media coverage, which fits with what we just discussed.
Okay.
Also, for individual U.S. stocks, those with lower foreign institutional ownership seem to react more slowly to the foreign signals. Maybe fewer globally focused investors watching them.
Interesting. And what about events? Did things change during, say, the COVID crisis?
They did find evidence that information diffusion actually sped up during the COVID-19 crisis.
Why?
Perhaps because everyone globally was intensely focused on the same overriding issue. You had heightened awareness, maybe faster reactions across the board, as everyone tried to figure out the implications simultaneously as it sort of synchronized attention.
A shared global shock speeding things up. And overall, are markets getting better at this? Is this speeding up over the long term?
The paper suggests yes. Financial markets seem to have become more efficient over their sample period in incorporating this foreign information, especially information coming from emerging markets.
Which might imply that the edge from this kind of strategy could be diminishing over time, particularly in some areas.
Potentially, yes. The low-hanging fruit might be getting picked more quickly as markets adapt and technology improves.
Now, what about that huge expansion to 13,000 signals? Did including individual foreign stock data make the forecasts better?
That was another slight surprise. You'd think more data, more potential signals equals better predictions.
You would, yeah.
But they found it didn't really improve the overall forecast accuracy much, if at all. The interpretation was that while there might be valuable signals hidden within those thousands of individual stock returns, they likely become much sparser. It's harder for the models to reliably pick out the true signals from the massively increased amount of noise when you add so many more variables.
So more isn't always better if it just adds complexity and noise. Okay, this foreign signal radar sounds intriguing, potentially powerful, but let's talk reality. What are the practical hurdles, the downsides, the limitations?
Absolutely critical points. Firstly, costs. Running a strategy like this involves frequent trading as the predictions change daily.
Right, portfolio turnover.
Exactly. You're constantly adjusting holdings. They estimated transaction costs based on turnover, using a fairly conservative figure per trade, and found that while the gross returns looked high, these costs would definitely eat into them.
Significantly.
Significantly enough that it likely makes the net returns more attractive for large institutional investors who have economies of scale in trading, rather than smaller players who face higher proportional costs.
So infrastructure and scale matter. It's not a DIY strategy for your average retail investor.
Probably not, no. Then there's risk. Even with positive average returns, the paper noted the maximum losses experienced in a single quarter for these strategies. They weren't trivial.
So you could still face significant drawdowns even if the model is generally predictive.
Of course. No strategy eliminates risk entirely. Market conditions change. Models can be wrong. That maximum loss figure is a reminder of the potential downside volatility.
And what about understanding why it works? You mentioned SHAP values trying to look inside, but is it still a bit of a black box?
It often is with complex machine learning. While they could identify which signals seemed important, like Qatar returns or signals from week 3, pinpointing the precise economic reason why that specific signal predicted a specific U.S. stocks movement, that remains really challenging.
So you might know what works, but not always the exact how or why in terms of economic transmission.
That's a common limitation. The models find statistical patterns, but the underlying causal chain can be obscure.
Any other caveats? What about that information diffusion time, those 5 to 8 weeks?
Well, remember that estimate was based specifically on lagged market returns. The speed could be very different for other types of foreign information, say news sentiment derived from text or economic data releases.
Okay, so it's specific to the signals they used.
Yes. And also, their modeling of the decay in signal importance over time used essentially linear assumptions. The real decay might be more complex, perhaps faster initially and then slower, especially over very long lags. So the time window is an estimate likely qualitatively useful, but maybe not precise to the day.
Understood. And one last result check. Did they try using this to predict the overall S&P 500 index, like adding up all the individual stock forecasts?
They did explore that, creating a bottom-up index forecast. The results were mixed. Some algorithms showed some modest predictive ability for the index direction, but it wasn't universally strong across all models. The neural network, for instance, struggled a bit here. The thinking is that any noise or errors in the forecast for individual stocks can kind of add up and get amplified when you aggregate them all together to predict the whole index.
So predicting individual stocks might be one thing, but accurately forecasting the entire market index using this method is maybe a taller order.
It seemed more challenging, yes. Okay, so if we were to sort of wrap up this deep dive on foreign signal radar, the big takeaway seems to be that, yes, machine learning offers this really potent lens for looking at global market links. It can potentially uncover predictive signals from foreign markets for U.S. stocks that maybe weren't obvious before.
But it's nuanced.
Very nuanced. The valuable signals aren't always where intuition points, as we saw with the Qatar example. And the speed limit for information traveling across borders seems quite variable, affected by things like media coverage, market type, and investor attention.
So for you listening, it kind of begs the question, could digging into these less obvious global connections actually provide some kind of edge? And what does all this tell us about how efficiently information really moves around the globe these days?
Good questions. And the paper itself hints at future directions, like applying similar ML techniques to even broader types of foreign signals, textual data from news, maybe even satellite imagery, things like that.
Expanding the radar even further.
Potentially, yeah. Trying to capture even more subtle global information flows.
Which leaves us with maybe a final thought to chew on. As these machine learning tools get smarter and more integrated into how people invest, is that going to fundamentally change the game? Will it make markets super efficient by finding all these signals instantly, or will it create new kinds of complexities?
That's the multi-trillion-dollar question, isn't it? How does this ongoing technological arms race reshape market dynamics and efficiency? Definitely something worth considering.